Welcome. Scott Fulton here. Good to be with you again. In this video, we're going to talk about financial planning in the context of retirement, but not in perhaps the typical way you may think about it. Do you have enough money saved for retirement? Well, I hope so. But in reality, of course, most of us aren't sure. There's just too many risks to know for certain. We spent a career thinking market risk was our biggest concern, but in reality, it's our health that will pose our biggest financial risk to our retirement future. I sat down with Bill Borton. Bill's an independent insurance broker. I think you'll find it interesting, and hopefully there's some good takeaways for you here. These are the excerpts from our conversation. If you're interested in the full interview, check us out at longevityadvantage.com. Enjoy. Welcome, Bill. It's a real pleasure to have you with us this morning. Really looking forward to our talk. For the students out there, can you give us maybe a little introduction into what your background is, the type of work you do, the type of clients you have, just to kind of get us pointed in the right direction?
Oh, my pleasure, Scott. Thanks for inviting me in. I am an independent insurance broker with a life and health and accident license. I am not working for any one particular insurance company. I'm appointed with maybe 30 or more insurance carriers. I hold myself out as a retirement risk manager and income planner. My clients tend to be baby boomers, plus or minus, who have between $1 and $10 million of invested assets. And so I am helping these baby boomers to live better longer, which is my tagline and my brand, basically, by helping them to figure out what the blind spots are that maybe whoever's helped them accumulate money for retirement hasn't really addressed. In other words, identifying what the risks are that can actually be managed, because you can't do anything about inflation, but the risks that you can manage, and then ways that you can do so as effectively as possible within your budget, your preferences, and so on.
One of the things that I run into all the time, and I think we all struggle with to some degree, is all through our career, we're really focused on the accumulation phase of building up our equity because we know we're going to need that in retirement. But that's a very different mindset, obviously, when we start to get into retirement. You must run into this all the time.
Oh, gosh, yes. It's a never-ending source of frustration. I understand where it comes from. I mean, when we were young, we were fed what I call the big lie. And the big lie was that when you retire, you're going to be in a lower tax bracket. And then they convinced everybody that IRAs and then 401ks were the way to go because you could put money away and not be taxed currently. And then they came up with what are called required minimum distributions, or RMDs, which says that you have to start taking that money when you're 70 and a half. And given the current state of our fiscal situation in this country with entitlements and what have you, income tax rates maybe now are as low as they're ever going to be. They're going to have to go up. And so not only are income tax rates going to go up, but when you add required minimum distributions to your other sources of income, such as Social Security, people are going to be in higher tax brackets than they ever imagined. And so the government's looking at taking in a big windfall from the boomers.
We all understand the benefits of starting to save early and get focused on the accumulation. But obviously, there's more to it than simply accumulate, and then suddenly the day you retire. So if I look at perhaps clients in their 50s, as they're starting to approach that window to start to make some decisions, are there some things they should be thinking about as they're coming up on that in that 10, 15-year window?
Well, so when you think about the span of a lifetime, the earlier years are the accumulation years where you're saving and investing. And you're also tending to do things like get married, have children, perhaps buy a home, then maybe, buy a bigger home, and you ultimately are trying to balance the spending and the saving and investing. And theoretically, if you've done a reasonably good job of that, at some point you can afford to retire. So once you get to that point where you start thinking about retiring, then you need to start thinking about how you're going to take what you've accumulated and turn it into retirement income. So when do you start doing that? I always tell people when you're age 50 or when you've made your last college tuition payment. And the reason why I say it that way is because there are plenty of boomers that had kids later in life, and it could be 60 or more before they've made that last college tuition payment. And I have met very few people in the course of my business that are willing and able to spend time thinking about themselves when they're still paying for kids.
Yeah, as we look at retirement planning and all the phases involved in it, we started in the accumulation phase, but of course we're really focusing perhaps on getting our kids up and through school, getting the mortgage paid, trying to work on our own career. And I certainly see this a lot where people, as a result of doing all that, tend to put themselves third or fourth down the list of priorities.
Not only have they done that, but in many cases they have literally mortgaged their retirement by taking home equity loans, 401k loans, co-signing student loans for their adult children, for their children. And it's a little known fact, but approximately 1/3 of all the student loan debt is owned by people who are over the age of 60. And it's not because they're going to college later in life. It's because, again, they've co-signed student loans. And so when you don't have a lot of time between when you've made that last tuition payment and when you theoretically don't want to or aren't able to work anymore and earn income, you end up having a real problem, because time, as I always say, is either our friend or our enemy, depending on how much we have.
So that really puts us into another pretty common scenario we're seeing where we went through thinking, we were just going to focus on our own retirement and really geared up once we got the kids through school, only to discover that we're now looking after our parents, and we're seeing this more and more as we're seeing more parents live longer. And so that then becomes certainly a financial burden as well as an emotional and time burden that a lot of families are running into.
We hear about the sandwich generation, which is one of the many colloquialisms that's been thrown around for a while. A lot of boomers had kids later in life. A lot of the kids are on the 5-year, the 6-year, the 7-year plan, as I like to say, switching majors, changing colleges as they try to find themselves. And at the same time, as you say, our parents are getting older, and many of our parents have not had the healthiest lifestyles in the world. And a lot of the things that they have done from a standpoint of diet, exercise or lack thereof, things along those lines, have caused their bodies and their minds not to be as good as they could be earlier in life. And so things really get crunched together here between the younger generation, the older generation, and it's not easy being a baby boomer these days.
It's hard to plan for everything. So with the thought around that is, what should we be thinking around the safety net when, for the unforeseen things that are very real? We just don't know which one we're going to have to deal with. I assume there's some strategies you'd recommend around that.
So for the boomers, our parents were the greatest generation. They were the people that grew up in the Depression and wanted to make sure their kids always had it better than they did, and went through World War II and then came back with the GI Bill, and everybody went to college, and college became a necessity, and Levittown was created in the suburbs and all that, and it really, everything changed from what had been the norm during the tougher years prior to World War II. And everybody thought of retirement as something you did at 65, and you retired on Social Security and a pension from that company that you worked for pretty much your whole career, and whatever savings you had. Well, along the way, pensions for most people have become the dinosaur, and a lot of people have not saved as much as they could have or should have. And so Social Security, was never intended to be a retirement income for someone they could live on. When Social Security was first created, the idea was you would retire and 6 to 12 months later you'd be dead. Nobody knew that people were going to live 25, 30 or more years after they stopped working, which is one of the reasons why Social Security is not in great shape. But Social Security for most boomers is going to cover maybe 40% of their retirement income needs. And so where's the rest come from? Well, there's a number of different sources. But when you're in that accumulation mindset, and if you have some type of financial advisor, wealth manager, whatever you want to call that individual, if you have someone, they generally have the accumulation mindset too. They're either actively or passively managing money, trying to get you up the mountain. And, we've seen commercials about what's your number, or the rule of thumb that you need 80% of your retirement earnings to live on a retirement. Those are all worthless. You don't live on assets, you live on income. And so the idea is, as you are approaching a point in time where you intend to retire, you need to start figuring out where are all those sources of income going to come from? And, there are many of them. So that's really, that whole idea of going from accumulation, going up the mountain, to getting down the other side safely, when how long you're going to live is an unknown. Taxes and inflation are unknown. You need to have more, not less, going for you. And most people don't even know what they don't know.
Right. Our main goal with all of our courses is, number one, is to help people ask better questions. And that's really all part of identifying where are the gaps, and then trying to come up with some reasonable planning strategies that can prepare people for what might be on the other side of the mountain. Not knowing what it'll be, but in all likelihood there will be some things to deal with. So part of that is getting some preparation ahead of time, obviously, and that as we look at it, there's certainly a financial plan and a health plan, because both of those are intimately connected, and waiting on either one of those or both is certainly a risky proposition.
Yeah, you can't buy homeowners insurance when your house is on fire. I've actually had boomers contact me and ask me if I could help their parent get long-term care insurance. And the parent may be 81 and nobody sells it over age 80, and their parent may have been diagnosed with dementia. So it's like, hello.
Talk to me a little bit about the phases of retirement. It's clear there are many phases to it. It's not simply we retire and that's it. And the mindsets that we may want to have when we start to think about those phases.
First of all, Scott, when I talk to people, either individually or speak in front of people, I try and bring in as much levity and as much humor as possible. And some of it I've come up with on my own, and some of it I've appropriated from other people. And the 3 phases of retirement, I think of a guy named Tom Hegna. I'm not sure if he coined the phrase or if he just uses it, but the 3 phases of retirement are the go-go, the go slow, and the no-go. And if you think about it, the go-go years are after you stop working. You're hale, you're hearty, you want to go see, you want to travel, take the cruises, play golf, see the grandkids, all that kind of thing. The go slow years are when your energy level starts to drop a little, and you've done that, and you're less into inconvenience than you used to be, and you kind of tend to stay a little closer to home. And so maybe your income needs are a little lower. And then the no-go years are the years when you're becoming frail, maybe some cognitive impairment setting in, healthcare costs become more of an issue. Perhaps you need some help with those activities of daily living. And, so that's a point in time late in life where income needs can spike up.
Most of us have a pretty good idea of travel budgets and what I describe as the early years, the go-go years, as you say, of what spend and run rates might look like. Do you have any line of sight into kind of some of the later year costs and what those might look like?
Well, so healthcare costs and long-term care costs are probably the 2 biggest potential drains on assets and detriments to a retirement income plan. And then the biggest risk of all is just longevity, not knowing when you're going to die. And the largest growing segment of the population are the 100-year plus people, the centenarians. And so when you don't know how long you're going to live, it's really hard to plan. But what we know is that longevity becomes a risk multiplier, again, as Tom Hegna says, because the longer you live, the more likely you are to need health care and long-term care costs as you get older. And so there are ways of minimizing or mitigating those risks, but you need to start much earlier.
What do you see as maybe the top one or two things that people should be doing to mitigate the risks around living longer? It's a good thing in theory, but of course it requires some planning.
Well, first of all, if you don't know how long you're going to live, then, you're trying to solve an equation that's got nothing but variables. And so I'm a big believer that the more variables you can eliminate, or at least partially eliminate, the better chance you have of solving the equation. And so there are life expectancy tables that the insurance companies use, that the IRS uses, and what have you. But they're basically worthless because they're an average. And for as many people that live less than that, same number will live more than that. And so what I found when I started my business 8 years ago was a website called livingto100.com, livingto100.com. And again, this has been out for maybe 10 or more years, and a physician created it. And you basically fill in a lot of blanks, answer a lot of questions, and provide your email address and hit the enter button, and it tells you at what age you are likely to pass away. And then I find it a little amusing. It will suggest that if you do more of something or less of something, it could add 6 months or a year. The first time I did it was about 7 years ago. And at that time, I was determined to live to age 99. Then, not quite 2 years ago, I did it again, and it came to 101. And I thought about it, and I said, all of my family history and diet and exercise and lifestyle and all that is pretty similar. What's changed? And then it occurred to me, I'm 5 years older now. And so you get back to that life expectancy thing. There are fewer people alive now that are my age than there were 5 years ago. Maybe not a lot fewer, but enough that could have bumped me up from 99 to 101. So I have this knowing that I'm easily going to make it to 100. And so when I think about planning for the long haul, I'm keeping that in mind.
We don't see everybody living to 100 yet. So what do you think were some of the things that contributed to that estimate for you?
Certainly not. I get annoyed, to put it mildly, when I read articles or I hear people speak and they claim that the longer lifespans are due to medical science, pharmaceutical companies, things along those lines. It really has nothing to do with those things. It has more to do with lifestyle and mindset than most people are willing to accept. There's a biologist who teaches one of the universities out in California named Bruce Lipton, who wrote a book 10 or 12 years ago called The Biology of Belief. And it's an excellent book. And in the book, Lipton suggests that 60% of our physical condition and experience is what we think about and what we believe. And the other 40% is what we put in our mouths. Food, or what I call faux food in many cases, and pharmaceuticals. And so longer lifespans in general are due more to public health and, cleaner water and, different things that have happened to society in general. But people who are going to bend the mortality curve, it's more about what they think about, what they believe, and what they put into their mouths. And it's so little of it has to do with genetics.
That living to 100 reference that you made earlier, that actually is it's the New England Centenarian study that's run by Dr. Tom Pearls of Boston U. Really interesting study. It's the biggest one in the world on centenarians. Super centenarians are 110. That's primarily their focus group. You can get in potentially at 105, but what their work is really showing is that genetics doesn't really start to kick in until after age 100 or 105 in terms of being a dominant player in lifespan. So what that also says is that really in our 70s, 80s, and 90s is that lifestyle really is the dominant factor in determining both our health and lifespan. So that's good news for most of us because it means, again, we've got a lot of untapped opportunity potentially in front of us if we want to pursue that. The challenge, of course, is that we've been told for decades that it was genetics, and that's what most people believe. So changing that belief obviously takes time, and people need to do some research on their own, perhaps, to validate that. But that's part of the retraining ourselves of many things that we've been told for decades that we're now realizing were entirely false.
Well, you think about it, it gives you permission to be a victim. It gives you permission not to take personal responsibility for how you live your life. We come back to what you think about what you believe. If you believe that breast cancer runs in your family, then it probably does. What you think about expands. It's not unusual for me to get a health history on a prospective client where they're taking 5, 6, 7 medications a day in their 60s. And you think about, they talk about side effects. Well, Bruce Lipton calls them direct effects. You're taking all these chemicals that, we just learned that, what is it, Zantac? Now they're talking about pulling that off the market when people have been eating that like candy for years.
And I know when I go in for the dentist or whatever the appointment, doctor's appointment, and you get asked a series of questions, and when I tell them that I don't take any medication at all, it's often met with "really?" And what that says is just how commonplace it is now that people are on medications, and by the age that I'm at this point. Now, one of the things that drives me a little crazy is when I hear people asking their friends or someone on the internet about what their thoughts are on different planning strategies, without really any understanding of how that fits. So it's obvious. Planning is a very individual thing, and I'm sure you're always tailoring a plan to not just their situation, but what their priorities are as well, which are going to be different as well. So it's you clearly are not looking at a one size fits all.
Heavens, no. So when I work with people, I start with what I call the conversation. I need to understand what people are concerned about, what matters most to them, what their preferences are, what their biases are, what their fears are. I need to know about their health history. I need to know all about their finances, because it's like trying to put together a 1,000-piece jigsaw puzzle. And just imagine trying to do that if you don't have the box lid with a picture. And so if you can create the picture in the first place, then you can start putting the pieces together much more easily. But if you don't have the picture, trying to put the puzzle together could take a lot of time and be very frustrating. And so I need to just continue to gather information, ask questions, go on and on and on, so that then I can begin to individually tailor solutions for people. I'm not playing like Goldilocks and the Three Bears where I'm spreadsheeting. We're giving you the one that's cool, the one that's hot, and the one that's lukewarm. If I'm doing my job right, I provide specific recommendations for people on how to, again, manage the risks that can derail a well thought out retirement plan. So, it's a process, but in the case of the person that has a lot, then you run into certain biases where, you don't need long-term care insurance because you can self-fund. And so, well, where'd you get that from? Well, my advisor told me. Oh, well, how does your advisor get paid? Well, they get a percentage of the assets under management. And so if you pull money out of your accounts, they're going to get paid less, right? Well, yeah. Okay. Well, so are they going to recommend that you give chunks of money from what they're managing to an insurance company? If they think that you can probably self-fund, there may be a conflict of interest there, or at least a bias on their part. And so, like and trust them, they have your money, and so you're tending to listen to them. But just because you can afford to pay for care potentially and still have enough income for a surviving spouse if you have one, doesn't mean that that is the most efficient way to pay for potential long-term care. So again, you need to be looking at all of these risks from different angles, and it's a good idea to involve different people who in some cases specialize, because we're not in an era where generalists do too well in any area anymore. Everybody's a specialist these days. I specialized in retirement risk management and income planning. I don't manage anybody's money. I don't sell car and homeowners insurance. I'm not selling mortgages, reverse mortgages. I have to understand all these things, but I specialize.
Yeah, I see this when I talk with elder law attorneys. Even people who believe they, and legitimately, we would all agree they seem to have quite a bit of equity and should be well positioned, who run into some fairly serious and enduring health issues, and just how quickly those costs run up.
Oh yeah. I mean, anybody who has accumulated any amount of wealth, and you made the example of somebody with $1 million or with $5 million or $2 million or what have you, depending on your lifestyle, you could probably take Social Security and $2 or $3 million and make it work, particularly if you have some home equity too. But if you don't have a plan and you're just kicking the can down the road because you either don't want to face it, or you have ignored some of the specific issues that need to be addressed, or your advisor tells you don't worry about it, you have enough to self-fund, then you can find out much later, when it's too late, that you don't have enough. And that's when you get the elder law attorney who's going to basically try and help you figure out how to qualify for Medicaid.
I take my students through a fairly simple financial model, really with the goal of trying to highlight where are the big risks that they're likely to run into. They can run through hundreds of thousands of dollars per year. And the way the system works is it'll take all the money that you have until you don't have any left. And then you're into obviously some very limited choices at that point. But yeah, it's hard to imagine just how big the stakes can be.
Having the money doesn't mean you have a plan. And I have been saying for years that everybody needs a long-term care plan. Not everybody needs, can afford, or qualifies for insurance. And there's nothing that says you have to buy insurance. However, if you understand that insurance and transferring some portion of whatever you perceive the risk to be to an insurance company might be, that there's leverage, there's other people's money basically, and there's tax advantages. And if you understand that if you have a spouse who's healthy and you need expensive care, your spouse is going to continue to live and spend money to live. Her lifestyle or his lifestyle isn't necessarily going to take a dive because you now require more income. And so you need a lot more income in some cases. So again, an insurance company can step in and really help with that if you plan far enough in advance. But I've met people that I've said, do you have a long-term care plan? And they go, yeah. And I say, well, tell me about it. It's with Genworth. And I go, no, you have an insurance policy. Do you have a long-term care plan? Yeah, I told you. And I go, no, you have a way of funding care or some of the care based on your policy, but that's not a plan. They get all indignant with me. So, I created a checklist, creating a long-term care plan, a checklist where where and how care would be provided, how to pay for care, consult knowledgeable professionals, discuss the plans with your family, and put it all in writing. Those are the main headings here. You could do this on the back of a napkin, but if you don't talk about it and you don't understand where care can be received, who can provide it, how much it costs, how inflation impacts it, what other ways it can be paid for, and discuss this with your family, and then get the necessary legal documents in place, it's a train wreck waiting to happen. And it may not happen to you because not everybody needs long-term care. But, there's only two ways you can die, Scott, conveniently and inconveniently. And far more people go inconveniently than conveniently, and going inconveniently is expensive.
Yes, when we think about the inconvenient journey, can you put that into context for us as to what your experience is?
Well, so one of the things that drives everybody crazy, both consumers and people on my side, is statistics. I always like to say, what Mark Twain said about statistics: there are lies, there are damn lies, and then there are statistics. You can bend the numbers to prove anything. Some of the studies suggest that men need care for, on average, about 2 to 2.5 years, and that women 4 to 5 years. And so, but some men may need care for 90 days. Some may need care for 9 years. It all depends. With dementia and with some of the chronic illnesses, the inflammatory illnesses like MS and Parkinson's and things like that, you can last a long time. And when you do get really a debilitating situation, you can't deal with home care anymore in many cases. And so it starts to get really, really expensive. But who can insure against the maximum risk? Who can afford to do that? So I'm always saying, all right, well, let's take a look at the statistics to start with. Let's take a look at what your experience has been with your family. Do you have any benchmarks to help you from a preference and a mindset standpoint? And then we agree on how much of the risk we want to transfer. How much of a monthly nut do you want to transfer? And how much will you retain and self-fund? And then how are we going to pay for that? So it's all a process, again, putting that puzzle together. But transferring some of the risk for most people makes a lot of sense, even if you have a lot of money. I have people I've talked to that have well over $10 million that buy long-term care insurance because they understand the value of other people's money, of the leverage, of the tax advantages. And, they insure other things. They insure their home and their cars and things, whether they need to or not. People buy insurance. They transfer risk.
It used to surprise me how I'd see people who were really smart with their money through their working years and accumulated some significant wealth, but somehow when they got to retirement, they were operating with a blind spot. And so I assume when you sit down with people, you really start to get into what are your goals. When I say the goals, when we think in the financial context around, is there an intent to have money left over for heirs or for charities, or they're looking to spend it out on their last day? And that probably ties in with how much risk they're willing to take as well.
So this is another whole issue. So many people don't really plan for their retirement. And I'm not talking about the money. I'm just talking about, what are you going to do for 20 or 30 or 40 years? What are you going to do? Where are you going to be? How are you going to age? How are you going to actively involve yourself in living better longer, staying young in body and mind? Are you going to retire to something, or are you going to retire from something?
The alternative where people are clearly retiring into something. They're suddenly finding their purpose in life. It ends up being probably the most meaningful thing that they've ever done at any point in their life. And just what an opportunity, again, it is for those fortunate people.
So there's a silver lining to every dark cloud. And we look back at 2008, and we look at the devastation that had on a lot of people and companies and families in the country. But in some cases, some of the people that were in their 50s or 60s that lost their jobs and are now finding themselves more or less unemployable, or certainly not employable to the extent that they were, are now thinking, gee, I can't go back into where I was. It's just not going to happen anymore. So it gave a lot of people an opportunity to kind of reinvent themselves in different ways and, find something else to do. Buy a franchise, become a consultant, go work for a nonprofit. It goes on and on and on. I have met many, many people in the last decade that got to some point, either voluntarily or involuntarily, in that second half of their life, that have just decided, I don't want to do this anymore. I want to find some way of shining my light, singing my song, finding out what matters most to me, and doing something so that I can enjoy my remaining time here.
I've had the opportunity to talk to a number of people in the financial world around retirement, and I remember when you and I first spoke, just how strikingly different you were relative to most people I've talked to. Do you see that when you look at your peers? Do you see much difference, or is that just my lens?
I think I'm a lot different than most people in a lot of ways. And I'm not going to go down that rabbit hole with you right now, Scott, but I tend to take a far more holistic view of my reality than most people. I find that most people in this country look for singular causes and singular fixes for just about everything. And they operate in silos. I tend to look at everything 3D, full color, understanding that everything's interconnected, and that if you move one piece, everything shifts. And so when you think about it, in order to live better longer, you have to be looking at everything. And it's like the one thing that you overlook is going to be the Achilles heel. Murphy's Law will never be repealed. And if something can go wrong, it probably will. And so you got to really make sure you're lining everything up. And that's not just your money and your insurance and all that, but also, again, what you're going to do, how you're going to live, how you're going to take care of yourself so that you can do that. What are the ways that you can take care of your body and your mind so that they support you for a longer period of time? You've probably heard me say that my definition of a successful retirement is when you get to the end of a long life with your body, your mind, and your money all arriving at about the same time.
One of the other things you've talked to me about before, which I want to share with everyone, is birthday milestones. Tell us what those are and when they happen and what we should be thinking about them.
Trying to give people the idea of a timeline from a planning standpoint. And so, did you turn 50 this year? If so, catch-up contributions may now be made to 401ks and IRAs. And then, did you turn 55? If so, and you retired that year, I don't know too many people retiring at 55 voluntarily these days, you can now take distributions from your 401k without penalty. Then 59 and a half, most people know that's when you no longer pay a 10% penalty on withdrawals from your 401k or your IRA. 62, now the year that you're eligible to claim Social Security, not that you should, but you're eligible. Also, it's the age in which you're eligible to apply for a home equity conversion mortgage or reverse mortgage. Did you turn 65 this year? If so, you may now be eligible for Medicare, depending upon whether you're still employed and have an employer-sponsored health plan. And then did you turn 70 and a half? And if so, now required minimum distributions, the dreaded RMDs, come along that can end up pushing you into a higher tax bracket and having all sorts of negative effects on your retirement plan. So those are the milestones.
Very helpful. Thanks. So when should I plan to take Social Security?
How long are you going to live? If you are 50 pounds overweight and you smoke and you eat fast food and you drink Diet Coke and you don't exercise, then chances are pretty good you should claim Social Security at 62. Because chances are you're a ticking time bomb and you're not going to bend the curve, the longevity curve. If you're like me and you had 3 grandparents live into their 90s, and you have a healthy lifestyle, and I cycle and I do yoga and I go to the chiropractor and I eat healthy and drink purified water and, meditate and do all these things, and, basically have a belief system that I'm going to live to be at least 100, then I'm going to wait until I'm 70 to claim Social Security, because every year you wait, you get an 8% bump. And where else can you get an 8% yield? And you also get the cost of living increase. And so the amount of money that you get from Social Security, if you can wait to 70 versus 62, is huge. How it gets funded will change over time, but it will be there. And then you also see that some people haven't got any way financially to get to age 70. Yet many Americans do have a way to get to at least full retirement age, and that's home equity, reverse mortgage. But, that's the last resort. Those things they're a scam. You shouldn't be getting one of them. Well, there again, it's one of those antiquated, biased belief systems that prevent a lot of people from prolonging claiming Social Security to the point of where they could get more income, and they just bail.
You raised the home equity loan there, or reverse mortgage. Rules that have changed, I think, quite a bit in the last couple of years, which I don't know that many people are aware of. Can you give us some insights into that?
Significant changes in the rules? It was October either a year or 2 years ago. First of all, reverse mortgages have been around for a long time, well over 20 years. And in the olden days, it used to be the Wild West. But it's been probably maybe a decade or so since the government has really gotten involved, and they are regulated by FINRA, and they're backed by HUD. And what they did October a year or 2 ago was they cut down on the amount of a reverse mortgage you could get based on the amount of home equity you have, to, again, make the whole program more self-sustaining. And as an aside, that whole program is infinitely more self-funded and self-sustaining than any other government program that I'm aware of, which it's like, wow, the government's actually doing something right. But the idea there is that millions of Americans have more potential retirement income in their home than they have in a savings or retirement plan. And so if you're ignoring that asset, that source of retirement income, it could be to your detriment in all sorts of ways. I have a good friend, Don Graves, who has written a book called Housing Wealth, and he refers to reverse mortgages as the Swiss Army knife of retirement income planning. He literally came up with 31 different ways that you can use the equity in your home to improve the quality of your retirement years. So again, I believe if you have any amount of equity in a home and you're at least 62, you have to at least take a look.
So I guess or from a planning perspective, this is one of the things we just want to have in our toolbox. So at least when the time comes, we're then going to be able to make a lot better educated decision, and not be having to make a hasty decision and be blind to what might be a great opportunity for us.
Heckham Advisors Group, he's created a course. He's an adjunct professor at the American College of Financial Services. He's a good friend of mine. And I actually worked with Don and used a Heckham, a home equity conversion mortgage, to help me purchase my home earlier this year. And it's a phenomenal financial instrument. And it's, again, if you understand something and you become informed, then the biases and the misinformation start to dissipate. But again, it's so important because we need different sources of retirement income: Social Security, home equity, annuities is something we haven't really talked about yet. Annuity is not a 4-letter word. And even though Ken Fisher says he hates them, he really doesn't. He's made billions of dollars thanks to annuities. So annuities, there's so much bias. There's so much misinformation. And part of it is because there's different kinds of annuities. There's different reasons to have an annuity. And again, these are insurance contracts that are issued by insurance companies. They can be funded with a single premium or a series of premiums. They can be qualified money, retirement plan money, or they could be non-qualified. They could be variable annuities where you're effectively investing in like separate accounts or mutual funds from the insurance company, which can go up or down in value. They're the ones that tend to have the higher fees that people are always banging on. Then you have fixed annuities that have no fees whatsoever. And you have immediate annuities where the money starts flowing to you in the source of income right away. The deferred annuities that the money can grow tax deferred for some period of time until you turn the income on. And then the annuities that are the most popular these days are called fixed index annuities, which have mostly the characteristics of fixed annuities, deferred annuities, and have a minor relationship to variable annuities in that there's a possibility of getting a greater return or more interest than you would with a traditional fixed annuity based on the performance of an index that the insurance company buys options in with a small amount of the money that you give them. And you're never invested in the market. You can never lose any of your principal or your value with a fixed indexed annuity, but you could end up with more interest than you would in a fixed annuity. Now, so if there's little or no fees, then what are the other objections? Oh, there's big high commissions. Well, you're not paying the commission. The commission's built in to the product. And when you buy the product, you know what you're getting. So the commission's irrelevant. Oh, well, then you lock your money up. They have these big surrender charges. Well, why do you have surrender charges? Well, the insurance company needs to invest longer term to give you the better returns that you get that you don't get with a bank, where you get a better return, you get tax deferral. There's no free lunch. So what they're saying is, we need you to commit to us for 5 years, 7 years, 10 years, or longer. And the longer you commit, the better the upside potential will be that you will have. And so again, it's planning and it's understanding how things work. But again, we come back to, one of my favorite quotes from Thomas Dewar, the Scotsman. Minds are like parachutes. They only function when open.
Yeah, that's great. And when we look at spreadsheets, chances are for most of us, that's not going to cause our minds to open up wider. If anything, it's going to have the reverse effect on us, isn't it?
Correct. Well, if you ever look at a fixed indexed annuity illustration, page after page after page of gobbledygook, guaranteed, current, non-guaranteed, all these index strategies, it's enough to make your eyes glaze over. People in the financial and insurance world don't understand them. At least they don't understand them well enough to explain them simply so that people can understand them. And then you get these so-called financial experts out there, the people that have the radio shows or advertising all over the place that, slam them. And you add all the bias and misinformation. And is it any wonder why people don't want to buy annuities? When in reality, they're a pension. They're a personal pension. They provide you with guaranteed lifetime income if you choose that option. And no other financial instrument can do that other than Social Security. And if Social Security is not enough and you don't have a traditional pension, you need to create your own, unless, of course, you're fabulously wealthy.
Right. So I look at annuities like all the other options we have. They're just another tool in our toolbox. And, we want to make sure we're using the right tools depending on what our situation is and manage each one accordingly going forward.
If you approach it from the standpoint of, creating an income floor, and again, we've talked before about the three primary ways that people devise retirement income plans. The one I like the best is the one where you can create a paycheck in retirement. You live your whole life with a paycheck, then wouldn't you want to continue to have a paycheck when you stop working? Well, that paycheck is made up of different sources. Social Security, again, possibly home equity, and some annuity income. Well, you calculate how much annuity premium you need to spend based on what the yield is that annuity will kick off for you and or your surviving spouse based on when you need to turn the income on. And then you can, again, back into the amount of annuity premium. And that annuity premium could be 10, 15, 20% of your invested assets. It could be 60 or 70% of your invested assets, depending on what you have and what your income needs are. But again, there's no rule of thumb. You need to do the math.
What about these hybrid life insurance policies that have become quite popular now?
Everybody's heard that people that bought older, long-term care policies years ago from the 120 or 30 companies that used to sell them, which is now down to maybe 9 or 10, something like that, that they've had all these big rate increases. And there were a number of reasons for that. The biggest one was that nobody knew that insurance companies were going to have to deal with a decade or more of not being able to earn any money on their investments because the regulators require them to invest in very safe stuff like bonds, and bond yields have been horrific since the economic crisis of 2008. The other two reasons are more and more people that bought older policies are getting older and are filing claims, and they're realizing how underfunded these policies were. They were many times sold with lifetime benefits, 5% compound inflation. So the reserves that insurance companies are required to maintain for all that potential liability are huge. And then a lot of people were expected to drop their policies along the way, and most people haven't. The industry has gradually over time started to introduce policies that are life insurance based, because life insurance in this country has been around for 150, 200 years. There's a lot of big, safe, strong companies that know how to price and underwrite life insurance. And so they have learned that they can combine life insurance with long-term care, or they can create life insurance where you can receive the death benefit if you need long-term care in ways that they can appropriately price, where they can guarantee the cost, and that if you never need care, there's a death benefit. And so there's a lot of variations on the theme, and a number of the insurance companies are introducing new enhancements, new versions of policies, different premium payment structures, because this, again, is the wave of the future. And so these policies overcome the use it or lose it objection, and they overcome the, well, my rates can go up objection.
Well, the idea of perhaps doing the planning isn't particularly exciting for people. Obviously, it's one of those things that once you get a good plan in place and you've updated it from time to time, really, I think what it says is you put together about as bulletproof plan as you think you can afford. And really, for everybody in that situation who does that, what I see in them is this freedom that comes over them, because they've really recognized they've managed many of the risks that were worrying them. They're happier, and they're really able to kind of get on with living their life more joyfully.
They can sleep at night. They don't worry. They can go out and do what it was that they planned on doing when they retired. It's ironic that most financial advisors believe that the systematic withdrawal plan is the best retirement income plan for everybody, because many of these advisors don't like annuities, or they don't really understand income planning. Again, they're the accumulation people. They help you get up the mountain. Well, at some point, you got to give the money back. So one of the things you might be motivated to do, and that we haven't talked about yet, Scott, is what's been called phased retirement. Again, are you retiring to something or from something? If you just can't wait to get out because you hate your job or you hate your boss or whatever, then you're retiring from something. And retirement is just like getting away from that. I don't have to go do that anymore. If you're retiring to something, what is it you're retiring to? Is it endless rounds of golf and cruise ships? Or are you retiring to do some philanthropy or some volunteer work, or maybe some kind of part-time income where you could do some consulting, where you can take your lifetime of experience and earn some money, which can help prolong claiming Social Security, which again is a good thing, And the longer you can wait for some of these things, the better. The more years that you can continue to earn some income. And it doesn't have to be a huge amount of income to make a big impact. So if you're retiring to something and you can continue to earn some income and be out there socializing with people and continuing to learn and help and grow and earn some money, that's a good thing, because again, that's going to keep you sharp and help extend the quality of your years in more than one way.
Yeah, for those of us who manage a lot of people and businesses and things, the idea of just kind of getting up and going to a job where you get to meet people isn't all bad.
I love what I do. You know, I've got a Medicare card. I ride SEPTA for free, but I have no intention of retiring. I have so much to do, so much that I want to do. And I tell people I may start slowing down. I'm 80 or 85. You know, one of my goals in life is to throw my leg over the top tube of my bicycle on my 100th birthday and go for a ride. It may not be a long ride, but I'm determined. And so here again, thinking long term, coming up with ways of seeing yourself able to do things and why, and making it part of your own personal mindset or cosmology, there's a lot of value to that. Again, 60% of your physical well-being is what you think about and believe, and 40% is what you put in your mouth. If you believe that, then you stand a chance. I discovered cycling. I was basically about 37 years old. I was still smoking at that point. I'd been smoking since I was 16. And I decided I liked it. And so it caused me to stop smoking a couple years later because I couldn't keep up to the guys. I didn't like it and dropped. Again, I wasn't trying to win races, but I was going out. I wanted to be, I wanted to keep up. And I loved cycling because it was fun. I was like going out and riding my bike again with the boys, and girls. And gradually I upgraded to the point of where I now have a high-end road bike. And I just love riding. It's my passion. I don't play golf, but it's meditation, it's exercise, it's keeping myself young. And I just absolutely love cycling. So when the sun's out, I'm not going to play golf. I'm going to ride my bike. And I declare what I call a cycling emergency now and again during a weekday, if the weather's nice, and I just go put my kit on and go out and ride. And I love riding around the hills of Brandywine because it's a great workout, and it's so beautiful here. Well, a lot of people who I have ridden with in the past used to run. And one way or another, we're no longer able to because of injuries and the like. Cycling's low impact. And I know people who are still very aggressive cyclists well into their 80s. And as long as you don't stop and just keep going, at what point are you too old to ride anymore? Well, again, if I can get my leg over the top tube when I'm 100, I'm going to do it. More recently, I took up yoga. And my wife's been doing it for years. And my chiropractor said, you need to stretch more. And have you ever tried yoga? And I went home and told my wife I was going to start taking yoga. And she's like, I've been trying to get you to do that for years. And, somebody else tells you and you decide it's time to go do it. And I go, well, dear, So, but then I discovered hot yoga. And so I'm to the point now where I hate it less than I did when I started. But I'm far from good at it. But guess what? I got to do it. So cycling I do because I love, and now I'm doing yoga because I need to. Again, it's just part of that living better longer, personal responsibility thing. So it's just choice.
Perhaps people don't appreciate is in terms of when we make lifestyle choices, how quickly things start to change. It's not an overnight thing, but usually in a matter of perhaps 2 to 3 weeks, certainly from a diet change, you'll start to see a difference. But any number of lifestyle changes, clearly the time that we've been moving through into a healthier choice, the easier it gets, and to the point of it's hard to imagine ever going back.
Cells are constantly dying off and regenerating. And so, I smoked from 16 to, 30s. And so I quit smoking on February 10th, 1992. I remember the day. I said, that's it. I'm done. And I went, back then you needed a prescription to get a Nicoderm patch. And 3 weeks later, I tore the patch off for the last time, and I never looked back. And then with all these years of cycling and the cardiovascular and respiratory, my respiratory system is better than most people who've never smoked. And part of it, again, is because of how I've lived, and part of it is because, you know, our body's constantly regenerating.
For some time now, you've been doing an internet TV program, Live Better Longer, which I just think it's a great concept. Can you enlighten us a little bit more about what that's about and what your direction is with that?
And said, I'd like to do a show. And he said, what's it called? And I said, Live Better Longer. He said, what's it about? And I said, having guests that come on that have things to share with baby boomers to help them live better longer. He said, when can you start? And so October of 2017, I had my first show. My first guest was my financial advisor. And we kept going after that. And I've had all sorts of interesting people on my shows. I'm going to be shooting the pilot for the new version of Live Better Longer. And I'm going to be bringing one of the guests that I had on my show before as my first guest. And so it looks like things may be coming together, and I will have a new pilot TV show, the new Live Better Longer, with your host, Bill Borton.
Great format, really novel, and absolutely fills a huge void in that space. So.
Well, when you're an insurance broker and you're talking to people about death, dying, dependency, paying insurance companies money, wondering if they're going to pay you, and all that sort of thing, you got to kind of try to find a way of differentiating yourself. And so a lot of people have helped me along the way. Live Better Longer, my tagline, came to me from a guy that I hired early on to help coach me and give me some personal branding and marketing consulting. And then I had lunch with an attorney one day a few years ago who said, I love that whole concept. He said, you pay the filing fee and I'll get a trademark pro bono. And so now I own Live Better Longer. I have a document from the Federal Patent and Trademark people in Washington with a raised seal, and it has, I own Live Better Longer. I own the URL. I haven't done anything with it yet. I have the logo. I have the TV show, and it's become my brand. And it's where I combine all the things, the mindfulness, and the lifestyle, and the insurance, and the money, and all that into one big holistic picture.
So I want to make sure people know how to find you. Can you tell us where they would look you up?
They can find me in a bunch of different ways. My website is w.r.borton.com, and my email is bill@w.r.borton.com. My telephone number is 856-817-6100. And I love to connect with people on LinkedIn, Bill Borton. I have a YouTube channel, W.R. Borton. I'm on Twitter, W.R. Borton. So I try and be as visible and findable as possible, but I love to connect with people, and I am a connector, and I like helping people. And so if anybody wants to talk about any of these things with me, be happy to talk. So please do get in touch.
Bill, I want to thank you so much for taking time out to really come and share, I think, some really valuable information, things that you know, obviously inside and out, and are really going to help some people. So we really appreciate the information you've shared, and look forward to talking to you again.
My pleasure, Scott. It's been delightful to get to know you, and I really appreciate the opportunity today.